Most people do not miss opportunities because the opportunities are invisible. They miss them because the opportunity feels uncomfortable while it's cheap. It looks boring. It has bad headlines around it. Or it sits in a market where everyone has already decided the story is dead. That is what makes an underpriced asset interesting. You are not looking for something perfect. You are looking for a real asset where the price, the fear, and the future use case do not line up. Today, we are going through 15 assets to watch this year, plus one bonus category that may be the most powerful of all if you have cash and speed. This is not personal financial advice. Some of these assets are liquid, some are extremely illiquid, and some require real expertise. The point is not to buy everything on this list. The point is to train your eyes to notice where the market may be throwing out something valuable, because the current story is ugly. Number 15 is old media entities. Mature publications, local newspapers, regional magazines, and local TV stations are not fashionable assets. Younger audiences have moved to social platforms, ad dollars have shifted, and many of these brands look like they belong to a previous era. That is exactly why they are interesting. Political advertising is a big part of the opportunity. Local campaigns need targeted attention, and old media brands still carry credibility with older demographics that vote and have strong buying power. Add newsletters, podcasts, local data products, better distribution, and smarter ad sales. And a tired asset can become a cash-flowing local influence machine. Number 14 is office space. Commercial office real estate has been one of the most hated categories since remote and hybrid work changed how companies use space. Valuations have fallen more than 30% below pre-COVID peaks in many cases, and new construction has slowed because the economics no longer work. Adaptive reuse is the key phrase. Some office buildings can become apartments. Some can become life science labs. Some can be repositioned for medical, education, creative production, or AI startup use. The market is pricing a lot of office space as if its only future is the old office model. A buyer who sees a new use before the market sees it may have a serious edge. Number 13 is international property. Many Americans look at domestic real estate and see stretched prices, difficult rent math, rising insurance costs, and mortgage payments that no longer feel friendly. Meanwhile, in some international markets like Portugal, Mexico, and Thailand, the price picture can look very different. The source thesis is currency arbitrage. In selected international markets, the opportunity is less about a blanket price crash and more about currency arbitrage, lower entry prices relative to many U.S. cities, and gross rental yields that can reach the 6% to 8% range in specific locations. Some locations also offer better walkability, lower daily costs, tourism demand, or a higher standard of living for the same capital. Number 12 is farmland. Farmland is not flashy, but it has one feature many assets do not have. It produces something people need. Food demand does not disappear because a trend changes. Land can also carry optionality through agricultural value, solar potential, water rights, conservation value, or long-term scarcity value. The setup right now is pressure. Crop prices have been falling while fertilizer and operating costs have risen. That can make farmland look less attractive in the short term. But when long-term assets become uncomfortable for operators, stronger buyers often step in. Billionaires and institutions have been watching farmland for exactly that reason. Number 11 is physical commodities, especially the infrastructure materials behind AI and electric vehicles. Attention goes to software companies, chip designers, and consumer apps. But underneath every data center, grid upgrade, EV charging network, and industrial build-out is a physical supply chain. Copper is the obvious example. The world wants electrification, and electrification requires copper. Data centers, transmission lines, vehicles, motors, and renewable infrastructure all compete for the same material. If demand keeps outrunning supply, the boring metal underneath the technology story may capture more value than people expect. Uranium is another example. AI data centers need massive, reliable power. Tech giants are exploring nuclear power because intermittent energy alone does not solve the need for round-the-clock power. Uranium is cyclical, political, and volatile, but the logic is clear. The AI revolution is not just digital. It is electrical. Number 10 is non-office commercial REITs. A lot of investors hear real estate and immediately think about offices, shopping centers, or apartments. But the REIT universe is broader. Some REITs own casinos. Some own cell towers. Some own data centers. Some own specialized properties with economics that look nothing like a traditional office building. Many REITs have traded at deep discounts during the higher rate environment. Because REITs are required to pay out a large portion of taxable income, investors often receive meaningful dividend yields, often in the 4% to 7% range, depending on the company and the moment. That cash flow can be attractive if the underlying assets are durable. Number 9 is bonds. For years, bonds felt almost pointless to many investors because yields were so low. Then rates rose, bond prices fell, and people learned that bonds are not risk-free if you have to sell at the wrong time. But after that reset, the forward opportunity changed. With 10-year treasuries and corporate bonds yielding around 4.6% to 5.5%, the asset class finally offers income again. For conservative capital, that matters. A safe or relatively safe return that beats inflation can become valuable when stocks are expensive and cash may not keep the same yield forever. Number 8 is energy companies. There is a cultural push toward clean energy, and over the long run, that shift matters. But the current economy still runs heavily on oil and gas. Data centers, shipping, aviation, manufacturing, heating, and global transportation cannot be replaced overnight. Traditional energy companies can look underpriced because many investors do not want to own them, even when they are extremely profitable. Low valuation multiples, disciplined capital spending, and large dividends can create a powerful shareholder return story. The market may dislike the image of the sector while still relying on its output every day. AI makes this even more important. Data centers need power, and the power demand is growing fast. Clean energy, nuclear, and storage will all matter, but existing fossil fuel infrastructure still sits underneath a huge part of the system. The hated asset is not always the bad asset. Sometimes it is the asset investors are embarrassed to admit they still need. Number 7 is healthcare stocks. Healthcare is a sector where short-term headlines can scare investors away from long-term demand. Cyber-attacks, Department of Justice probes, Medicare pressure, reimbursement fights, and drug pricing anxiety can all hit sentiment quickly. But structurally, healthcare demand is not going away. Aging populations need more care. Chronic disease does not disappear. Innovation continues in drugs, devices, diagnostics, and care delivery. When strong healthcare and pharmaceutical companies trade at historical discounts while buying back their own stock, investors should at least pay attention. Number 6 is cybersecurity. AI is not only helping legitimate companies move faster, it is also helping attackers move faster. Phishing can be personalized. Code exploits can be searched for automatically. Social engineering can scale. Small teams can now create threat volume that used to require much more manpower. That creates a long-term arms race. Companies, governments, hospitals, banks, schools, and infrastructure operators cannot simply opt out of security. The more digital the economy becomes, the more essential cyber defense becomes. This is not a luxury budget line. It is increasingly a survival budget line. Number 5 is international stocks. The U.S. market has delivered extraordinary returns, but much of that performance has been concentrated in a small number of giant technology companies. When one market becomes expensive and narrow, the risk is not that it must crash tomorrow. The risk is that future returns become harder to earn. Europe and Japan have offered better valuations in many areas, and in some periods better returns. International exposure also acts as a hedge against a stagnant decade in U.S. equities. If the U.S. multiple is high and expectations are already heroic, owning assets outside that story can make a portfolio more resilient. Number 4 is next-generation peptides. The public story right now is dominated by weight loss drugs, but the broader biotech opportunity may go far beyond that. Advanced peptides are being explored for metabolic health, cellular regeneration, anti-aging, and other therapies that could reshape how people think about prevention and longevity. The source thesis is that the market could expand dramatically as treatments move from injections toward pills and easier delivery methods. Convenience matters. A therapy that is powerful but unpleasant to take has one market size. A therapy that is effective, easier to use, and broadly accepted has a very different market size. This category is speculative. Science risk is real. Regulation is real. Hype is real. Many companies will fail. But if the next wave of peptides moves from niche treatment into mainstream metabolic and regenerative medicine, the winners could become some of the most important healthcare assets of the decade. Number 3 is emerging market stocks. Countries like India, Mexico, Brazil, and China have growth drivers that look different from the developed market story. Industrialization, nearshoring, demographic shifts, consumer growth, infrastructure build-out, and in some cases, strong GDP growth from a lower base. The valuation argument is simple. Emerging markets often trade at earnings multiples far below the US, sometimes roughly half the valuation. That does not automatically make them safe. Governance, currency risk, political risk, and market structure matter. A cheap market can stay cheap for a long time, but lower valuations plus real growth can become attractive. Nearshoring can help Mexico. Domestic consumption can help India. Commodity cycles can help Brazil. China is more complicated, but complexity is also why assets can become mispriced. Number 2 is Bitcoin. Bitcoin is volatile, controversial, and still misunderstood by many investors. The source frames it as a standard mid-cycle correction, but still as an asymmetric bet for the next decade. The logic is not that Bitcoin is safe. The logic is that the upside, if the thesis is right, may be much larger than the downside of a properly sized allocation. Two arguments matter. First, exchange reserves have been described as hitting record lows, which suggests fewer coins available for sale on exchanges. Second, institutional accumulation has increased as more traditional investors treat Bitcoin as a real portfolio asset rather than an internet curiosity. The deeper thesis is fiat currency devaluation. If governments keep expanding money supply over long periods, scarce assets become attractive. Bitcoin is one version of that argument. It is not for everyone, and position sizing is everything. But as a hedge against monetary debasement and as a high upside asset, it remains one of the most important assets to watch. Number 1 is cash flowing small businesses. This may be the most practical opportunity on the list because it does not require predicting the next big public market trend. It requires finding a boring, profitable, essential business and buying it at a reasonable multiple. Millions of baby boomers are retiring and many own local service businesses with no clear succession plan. Plumbing companies, HVAC operators, car washes, laundromats, specialty repair shops, bookkeeping firms, and other essential businesses may not look exciting, but they can produce real cash flow. The source thesis is that many of these businesses can be bought for just 2 to 4 times annual cash flow, sometimes with seller financing available. If the seller wants retirement more than a perfect headline price, and the buyer can improve marketing, systems, and operations, the returns can be better than anything available in public markets. The danger is that small businesses are not passive investments. You are buying operations, people, reputation, customer concentration, local competition, and hidden problems. A cheap business can become a full-time job with surprise liabilities. But for the right buyer, cash-flowing small businesses may be the best example of an underpriced asset hiding in plain sight. The bonus category is distressed sellers. This is not one asset class. It is a situation. Divorce, probate, bankruptcy, partnership disputes, over-leveraged owners, health issues, and urgent relocations can force people to sell quickly. In those moments, speed can be more valuable than squeezing out the highest possible price. This is where cash becomes a weapon. A buyer who can close fast, remove uncertainty, and solve the seller's immediate problem may get a price that a slower buyer never sees. The opportunity is not exploiting people. The opportunity is providing certainty when certainty has real value. That idea connects the entire list. Underpriced assets often appear where other people see friction. Old media has an image problem. Office space has an occupancy problem. Farmland has operating pressure. Bonds were ignored. Energy is unpopular. Healthcare has headline risk. Emerging markets have complexity. Small businesses have owner transition problems. Distressed sellers have time pressure. The investor's job is not to be reckless. It is to separate permanent damage from temporary discomfort. A cheap asset with broken fundamentals is a trap. A cheap asset with durable fundamentals, a path to cash flow, and a seller or market that is overreacting can be an opportunity. If this gave you one asset class to research more seriously, subscribe to the channel, hit like so more people can find the video, and comment with the one asset on this list you think is most underpriced right now. The best opportunities are rarely the ones everyone already loves. They are usually the ones people are still arguing about.